How are you, buddy? Just passed you the baton. Thank you for coming again, Mark.
Pardon me?
I can
Can you hear me
bro.
now?
Yeah, Mark. How
Okay,
are you
great.
today?
Wonderful. Thanks for having me, Dale. I appreciate it.
Okay, so let's start with what's happening today before we get to the charts, Mark. Your expectations for the Fed, and follow-up question: will Powell be different than Yellen and Bernanke? And do you see this as a different Fed than what we're used to, with the market always believing they have the Bernanke Yellen put?
Yeah, I mean, I think it is a little bit of a different Fed. I think you can argue that. The expectations obviously are for a quarter point hike, and many are just wondering about forward guidance. The data today came in much hotter, arguably, than expected, and that's going to be a continued issue. The fact that you're starting to see data get incrementally better and better, but yet there's still real issues with regards to productivity and GDP, which is still very low, and nobody seems to have the answer to that outside of just thinking that we need to address things like entitlements and other things to really get GDP growth up to near 4%. So my view, honestly, is that the Fed is hiking into a fragile recovery. I don't.
1937, Mark? Isn't that what they did in 37?
Yeah, I mean, I think, well, the interesting time you mentioned the 30s, I mean, it's very similar to this time in some ways, where we had, the bear market peak in 29 to sell off into 32, huge debacle. And, the subsequent decade was spent with the banks trying to, buy up assets. And then, of course, they were villainized, and that hurt Roosevelt, and they had to shut down the banks. And then there grew this disparity. Wall Street rebounded from 32 to 37, but the broader economy went through a very difficult time. And I think that is not unlike what we've seen since 08, 09, where the markets rallied, but yet the economy just sort of muddles along. And we're gaining some traction a little bit now, arguably, but, still a lot of issues. Some of them might be demographic, where more people are leaving the workforce than any time, in history. More people retired now than working. And so that could be, part of the reason why the number of people in the workforce has dropped off. But, it's just, it remains, an economy that you can still argue on both sides. There are people that are very frustrated over the last 10 years with regards to the regulation, anybody that works in the financial space. And, that's starting to be addressed, I think, slowly but surely. But, it's still a tough economy. To argue that it's red hot and everybody's working and everybody's making money, the sentiment certainly doesn't seem that way. It seems like, we're in the latter stages of this economic cycle, but yet nobody's really happy with the pace of growth. And so we're at the second longest economic expansion ever, and pressing on, longest market rally almost in all time, but yet people are still having a lot of difficulty making money.
Yeah, let me, that puts the bonds in a very interesting position. I see your yield chart up here, Mark. I've been saying that the most embraced market thesis on the street, in the cosmos, is that the bonds are in a bear market. And I look at the yield chart here, and I even go real macro on a monthly, and maybe people have it wrong again about the bonds. What's your outlook here?
I think it's going to be difficult for bonds to sell off too meaningfully, meaning, yields rise dramatically over 312. I don't see that happening in the next couple of months. I see there being a greater likelihood of us, potentially pulling back a little bit in yields. I think sentiment has been very negative on treasuries, and historically that's marked pretty good buying opportunities for those seeking to buy treasuries. So I don't disagree that momentum and everything seems to have shifted, and we seem to have potentially carved out a low in yields in 2012 and 2016. But I just don't see how yields can make meaningful progress higher when everybody's betting that they need to, and that's going to happen. And I think that's where we are now.
Well, I mean,
sentiment is more bearish this year than it was last year, right? So we still have close to minus 400,000 short treasuries, and last year that marked a peak in yields from what 260 down to 2%. And so now we're up. We've gotten TD sell setups on yields similar to what we had in 14 and 06, and so these do tend to be important. I think we'll see if we can make much progress. Yields seem to have stalled out right near this trend. In the last week, they've been very lackluster. We continue to try to make gains, but yet they're we're seeing treasury yields into the close, yields pull back to ride flat. And that's really hurt the financials, I think, and that's a key part of the stock market.
Yeah, but you look at things like the XLF, and they've already retested Feb lows quite a few times. To me, it looks like if we do have a market correction, which I think might start this week, that financials will lead the way by taking out its February low first, because it's already tested it a few times.
Yeah, the XLF has been in pretty, and this is a chart just of the XLF and showing what this, and so we've been unable to really show very good signs of progress here. When you look at relative charts, they've been even worse in terms of how this looks, and I think that's important to point out that financials, relatively speaking, peaked out in February, and this is a longer term uptrend for the last 2 years of financials versus the S&P. So we've seen a 2-year trend line break of financials and being at their 15% or so, a very important, piece of the puzzle to not have working at a time when people are very optimistic on the market.
Do you think it's related
technology
to
sales? So go ahead.
Do you think it's related, Mark, to all the fears about Deutsche Bank, that it possibly could be a contagion and eventually, and that's why people are worried about U.S. banks too?
I wish I had the answer as to why exactly it's happening. Sure, that's
or the flattening of the yield curve. Could that be it?
Yeah, that's also a problem. I think I look at pure technicals. I look at the here and now and not try to gain too much conviction on why I think something's happening, because
I understand.
When the charts change, you have to look at that, and that's simply, from a DeMark perspective, we got sells on a relative basis and financials back the latter part of the year, and we're still seeing some deterioration. So tech and financials are 40% of the market. If those areas aren't going to work, and tech obviously has worked quite well, but now you're seeing a stalling out in technology just in the last few weeks, and so that's a little bit of a concern when you have the two big generals of the market, which
how about
everybody's looking to lead us higher.
All right, so you're talking about generals. What about King Dollar? So this was a very impressive dollar rally. Cleaned out a lot of Euro bulls from over the 120 level. Where are you at on the dollar? Was 95 just a short-term peak, and we get a little pullback, and then we're going to higher levels? Do you think this could turn into much more of a dollar rally than the market was expecting even a month ago?
I think in the near term that it's still likely that the dollar probably pulls back in the months ahead. I remain sort of a dollar bear over the next 5 or 6 years, whether on an intermediate term basis, if any dollar pullback in the next couple months provides a chance to, for those to still stay long the dollar. I don't know that. I think that we have seen some intermediate term progress, obviously, in the dollar, which happened back in April. This is the Bloomberg dollar index, which has a much lesser exposure versus the euro, but you're seeing, we're seeing evidence of counter trend exhaustion here. We haven't even gotten up to October highs. So I'm thinking the dollar is in the process of stalling out, and seasonality bodes well for dollar weakness, typically starting in June through October, typically. So I'm thinking the dollar is going to start to pull back, and that could provide a chance for those to get long the metals. I think euro and pound sterling have been attempting to bottom out slowly but surely, but I think if you look at the dollar longer-term charts going back over the last few years, it's certainly been a decent rally that we've had in April. It caught a lot of people off guard and was important to pay attention to. I would argue that in the short run,
develop a right
this
shoulder
correction.
Yeah,
and that's the whole thing. I mean, that's the longer term chart when you pull it up. To put things in perspective. Let's see if I can.
It looks pretty good.
So, this in the near term, you look at the longer term path, and it doesn't give a lot of conviction for, right now we're basically neutral over the last few years, right? So we have made progress throughout up in 15, and it's just choppy. I think for the bears to gain conviction, you need to get under the lows that we saw earlier this year, which would bring about a huge decline. And I don't know that that's going to happen right away. I think you see a minor pullback over the next few months. It likely provides, a chance for maybe further rally a little bit, but I don't have a lot of conviction. I was, you turned bullish in April, and it's right to be long. Now I think we're stalling out, and actually I see a sell-off in the dollar. So I think euro and sterling likely rally. And
you like the metals as well in here? Because
the base metals have started to turn up. The precious metals, it's been very frustrating for bulls of silver and gold. We saw a little bit of action in silver last week, but yet the charts in gold have been pretty frustrating to try to call for any meaningful type breakout. We've stalled out, and we're sort of in this choppy range-bound pattern near the longer-term trend from right near the election. I would say, though, that the sentiment has gotten pretty negative now on gold. And so, when I look at this area, technically it doesn't make me excited to buy gold just yet here. I think that, this could be a corrective pattern that you end up getting, one final pullback to new lows that ends up being a buying opportunity. And so that's something that I'm always on the lookout for, is that a pullback down to this area, 1250, 1240 would be an excellent chance to get long, because I think sentiment has already gotten quite negative. So, but we need the dollar to turn down and for yields to turn down, really, for gold to work. And recently yields have been moving higher, and so that doesn't really bode well just yet for gold. But I think we'll have our chance to get long. And really anything over recent highs would make me very bullish on gold above 1310. I think that really paves the way for the start of a rally up to challenge these highs. The longer term pattern's been, as you mentioned, pretty, right now we've been range bound for the last few years, but arguably a much bigger base in the making that could, lead to
that measures
some
like
type of a larger rally.
That ascending triangle measures to about 1600. If we break out.
So this is the longer term, trend from 2011, which you could argue we did see a minor breakout, but we haven't followed through. So it's been sideways. And so we need to see the move over to 1370, which, given how many people watch this, we'll see exactly. I presented this at Stock Charts. The website had their seminar, the conference out east in New York a couple months ago, and I presented this as being a very attractive idea, simply because of the degree of consolidation after this breakout, and I saw that the chart pattern is growing a little more constructive. But this really does depend on the dollar turning down sharply, and for the economy potentially to weaken in a way that yields would also start to pull back. And so that's going to be necessary, I think, for gold to work.
Okay, and does this pullback include indexes? You have any cycles or times that are saying that we could be getting close to something, or we're just going to blow to new all-time highs here?
No, I don't think we blow to new all-time highs. I'm a little more pessimistic, and I've been pretty bullish over the last month. But I think we're at a time when many people are looking at this time and the middle part of the month as being important for a few reasons. But it really echoes what we've seen over the last couple months, and that's what's truly interesting about this market, is that when you take a look at how stocks have moved of late, we saw the peak in the middle part of March. We sold off into end of month. We bottomed out early April. We rallied till April 18th. We peaked out. We fell to early May. We peaked out in the middle part of May. We sold off to end of month. Now we've rallied into the middle part of June. We've done that over the last few months already. Now we have evidence of exhaustion DeMark-wise, based on one measure, the other will take another 4 days. I'm not confident that we break March highs in the S&P before we start to turn down. So I'm looking for a peak sometime in the next 3 to 5 days, based specifically on, a couple different cycles, and also just given near-term overbought conditions. I think there's divergence that needs to be watched not only in the U.S. indices but also abroad, because Europe really has not been participating of late. I think that's a concern. You have the Nasdaq that's moved to new highs, but yet the S&P and the Dow haven't.
Yeah, have you ever seen that much disparity, Mark, with the Nasdaq making new highs and the S&Ps being 100 handles off their high?
It happens over time.
I can't recall.
I think it's interesting.
Yeah, I can't recall a time.
It's an interesting market only because small caps have had a very healthy rally of late, and the IWM and everybody points to that as being very constructive. And the advanced decline is also at new all-time highs, and so that's it makes it tough to argue for a greater market peak just yet. You need to see some evidence of divergence, and you just haven't seen that. So I'm more calling for a short-term correction. I do think July could be interesting for those to study. What Putz wrote about eclipse cycles, and there should be some interesting things happening from the middle part of July into late July, which I think can be a pretty serious turning point for the market. And but I don't know that we're going to see any real damage done until you might rally into the fall and into September, October, and I expect that rally could happen on a lot weaker breadth and momentum, and maybe set up some of those divergences that could allow for a peak. But I see the market as still being pretty healthy based on longer. Can't be a real bear based on weekly, monthly trends of the S&P. Just going back, bear with me. Let me see my chart can load. So yeah, here's the longer term trend of the S&P. We haven't really seen any divergence. We do now have weekly TD sequential sells, and we're seeing DeMark sells now across many different indices on a weekly basis and on a monthly basis, and the dailies will be there within a few days. So
your first
turn down sharply.
Your first green line above 2400, Mark. Your first green line, dotted line.
Yeah.
On your chart, it looks like a little bit above 2400, where your bars are up on top. Oh,
yeah, that's just a longer term. That's a TDST level based on the Mark system.
Well, that's also fairly close to a C wave target if we peak here without making new highs, 24.5 or so.
Yeah, I mean that's a first meaningful fib level from the entire move up since 2016. So I do think the next couple months can be rough, and I think that we can attempt to pull back from here. Even 5 to 10%. I don't see that as being unrealistic, but I think tech is going to stall out. I don't think the stocks can carry us up, and I don't like the patterns in indices like that, and technology being 25% of the market, 26%. I mean, it's just going to, my thinking is you can start to really pull back here.
Yeah.
And so transports haven't participated. Now we're coming into what's widely known as being really the worst part of the month, and the worst month of any midterm election year. So, June has been number 12 of 12, the worst month of the year. The average return is minus 1.7%. And since 1950, and the S&P has been up 2.5%. So there seems to be a perfect storm brewing for a potential peak in the next week, and we'll see if we get that.
Okay, I really appreciate the insight, especially that bottoms on the early part of the month, peaks in the middle part of the month. Any view on oil here, Mark? We had that washout from 72.80. You're looking for continuation of the trend, or may there be a buying situation setting up?
I think that is right. I think the longer term trends are still intact, but you did see a good degree of weakness, from the peaks that we saw in May. So I think you rally into the end of the month into early July, and potentially you can peak there again. I view, the short term trend line was violated from the last few months. and many people will bring that up as being important, and it is. But I would argue that a move above 67 sets us up for a move back to challenge the low 70s, and that's probably a chance to sell into it, given the extent that momentum has started to shift from just mid-May. So I'm not a real longer-term oil bull. I think that it's right to be tactically positive here and really adding to longs as you start to move higher. But I would really look to trim longs in the low 70s. And energy as a sector really hasn't participated all that much to the degree that crude has moved, and that's been an ongoing concern for the oil bulls.
I found it interesting. I saw a tweet of yours late last week talking about the lack of volatility in crypto. So that means you're covering it. And it seemed to have been a harbinger for extreme volatility in crypto on a Sunday over a hack. So, what are you looking at?
We've consistently seen some pretty outsized moves happening, during the weekends and most of the cryptocurrencies, which is sort of interesting. I mean, it seems like you sort of lollygag through the week and then you get the big moves on the weekend. So we're certainly at interesting areas now. Bitcoin is arguably, we've really broken April lows, but we're not really accelerating lower. We're just sort of sitting there as of now. So this is a daily chart just of Bitcoin, which has been a little bit weaker than things like Ethereum. And, I think it's going to be, potentially still, I'm looking for a low, but I think it's really tough to argue we're there. So I was trying to play this from the long side up until this weekend, and I got stopped out. And so I'm sort of sitting on my hands and waiting for this to show me more signs. Either going lower over the next week would produce a buy for me, or evidence of this snapping back up above 7,100. So
thank God you're not a hold on for dear life hodl guy, and you had a stop in, and it's interesting to me that you're even trading crypto right now, Mark. That's interesting to me. So you think that besides price moves, you must be positive on blockchain and beginning to educate yourself in this new asset class?
Yeah, I think it's interesting. I think it's a couple things stand out to me, and one is that the entire world of people that are not affiliated with the blockchain, that haven't built the infrastructure, most of those people have been pretty bearish on cryptocurrencies. Either they don't understand it, the sentiment has been bearish, yet the banks are going full throttle towards this and opening up trading desks left and right, and the futures markets are expanding, and most countries in the world, like Japan and some other countries, are making major inroads towards allowing customers to buy things using Bitcoin Cash and Bitcoin, and that makes me have a lot of interest, because nobody else is interested and people are negative on it, yet now we're right back at April lows, and that sniffs of opportunity for me. It just does. I think that, the banks wouldn't be going into this like they are just to save face. And I understand that sometimes they act because others do the same thing and they don't want to get caught behind the curve. But, people have seriously invested some real time in studying this. And, the correlation to equities really isn't all that positive, and it's pretty negative. So for me, something that I can trade. I mean, it's interesting, and there's a lot of volatility in it.
Yeah, a lot of volatility. And do you buy the correlation that Bitcoin crypto is kind of a feature of the animal spirits speculation being here, and we've seen a couple of moves in indexes be correlated where Bitcoin actually, or cryptos, led the way up or down?
Mm-hmm. Yeah, to some extent. I think, well, I don't know about the correlation. We did see times in early April and in mid-month where we peaked out and have been similar, and other times where it hasn't. I mean, people have talked about a lagging cycle of 40 days. I don't think there's the interest. I know probably 3 to 5 people that are involved, and the majority of people I know don't know about it. you know.
That's because you only know old people now, Mark.
That's right. That's a good point. Yeah, no, I'm getting old, and I don't know the. Oh yeah, me and my millennial friends all own it, and we love it. No, you're right. It's
it's a new
people are conservative.
Way.
They don't want to take the time to understand it, and I think that's gives an advantage to somebody like myself that can trade it technically, and I don't mind if I'm wrong a few times, because when the trend finally starts to work, I'll be there and I'll own a lot of it, you know. So
okay, Mark. So you want to show your website so people know how to reach you and possibly follow you, subscribe to you, etc.
Yeah. So I started up my own business 2 years ago called NewtonAdvisor.com. So for those that don't know, I used to be an equity options trader in Chicago. I worked with Morgan Stanley for a few years. I worked with Diamondback Capital.
Where do you live?
That ended back in 2011. So I live in Fairfield, Connecticut, but I commute down to the city probably once a week and do a lot of media there. And so I'm happy to give people a trial. And for anybody that mentions they listen to your call, Dale, I'm happy to knock off, 50% off the first month. But I cater to mostly institutions, but I wanted to open up my research to individuals as well. So individuals don't get the personalized customization like institutions do, but I basically try to write at least 2 notes every day, and I do a video every morning. I do conference calls. One of my own is going to happen tomorrow at 1 o'clock, and so go to NewtonAdvisor.com and see what we're doing. Happy to talk to you about what's going on here.
All right. Well, thank you, Mark. And I think there is a huge void for real good research and analysis in the crypto arena. A lot of people out there are, following, people that don't have the kind of technical background you do. So thanks very much for your time today, Mark. Some very insightful views like usual, and good hunting and after the Fed and the ECB and BOJ, and until the next time we speak.
My pleasure, Dale. It's always happy to be on your show. It's certainly a lot to look at. So I'll be on CNBC this Friday, I believe, at 2:30 for those that would like to check that out further. So
all right.
Thanks for having me on.
You're welcome. I'm expecting an 8x10 autographed glossy photo of you in the mail. So
I love the exposure, but they don't pay me, so I just do it to try to spread the gospel, just like you. So
thanks, Mark.
Enjoy your summer, and let's touch base again soon.
All right. That's Mark Newton, everybody. Thank him. My trading warrior brother, Mark Newton. You can find him on Twitter at Mark Newton. It'll come up. I think he has CMT after it. And
go Mark to his Newton CMT. That's good.
Okay, and go to his website. And that's a wrap for us. Good luck with the Fed today, everybody. See you tomorrow. And most of all, don't just count your pips. Count your blessings. See everyone tomorrow. Adios.